Hello, everybody. Welcome to Wiley Solution walkthrough. This is for accounting tools for business decision making. The authors are Paul Kimmel, Jerry Weingett, and Jill Mitchell. This is for exercise 25-3. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are yours truly and not the authors of the textbook of Wiley, excuse me. Okay, before we thank the bus driver, let's come right over here. Okay, so right over here, we've got Hillsong is considering purchasing a new sewing machine. Sounds like an attorney, for $2.45 million. Its existing machine was purchased 5 years ago at a price of $1.8 million. 6 months ago, they spent $55,000 to keep it operational. The existing sewing machine can be sold today for $250,000. The new sewing machine would require a one-time $85,000 training cost. Operating costs would decrease by the following amounts for years 1 through 7. Then it tells us that the new sewing machine would be depreciated according to the declining balance at a rate of 20%. Salvage value is expected to be at $400,000. The new equipment would require maintenance costs of $100,000 at the end of the 5th year. Cost of capital is 9%. Use the net present value to determining whether Hillsong should purchase the new machine or replace the existing machine, and state the reason for your conclusion. Now, the first thing we need to kind of really do with this is say, what is a relevant cost? Well, a relevant cost is going to be something that we're going to be going through and basically spending out today. So the existing machine that was purchased 5 years ago at a price of $1.8 million, that is a sunk cost. Can't get that back. We're not looking at that. We're looking at the future. I spent 6 months, $55,000 to keep it operational. That is also a sunk cost. Can't do anything about it quantitatively. Qualitatively, can we fire management? Sure, but that's a different discussion. The existing sewing machine can be sold today for $250,000. That's relevant because I can actually get back some of my, if I buy it new, I can sell my old one now. The new sewing machine would require a one-time $85,000 training cost. That's also very relevant because I would have to pay for that today. Operating costs would decrease, right? So these are going to be some cash flow savings, right? But we also have over here now, with the depreciation, there's no way without understanding the tax benefit of it. When we look at depreciation with net present value, we're more concerned with cash flow than we are with depreciation. Now, if this was to save us something in tax, possibly, but we don't have enough information. Salvage value, this is how much I'm going to get in year 7. So this new equipment, we require maintenance costs of $100,000 at the end of the 5th year. Cost of capital is 9%. So what we need to do is we need to figure out, we've got year 0, right? So, and when we're looking at net present value, we're focusing on cash flows. So in year 0, what did we spend? Well, over here, what do we have? We basically have the cost of the new machine. The cost of our new machine is $2,450,000. Okay, less the old machine sale. If I sold the old machine, I would get $250,000. Okay, so if I sold the old machine now, I would make $250,000. I have the training. My training is going to cost me, or I should do it like this. So that's going to be my outflow, right? I'm going to get $250,000 as an inflow from selling the old machine. So for my training, I've got $85,000. So my total outflows are going to be, for year 0, $2,285,000. Now, when I go ahead and look at present value, right? So I've got these savings. So in year 1, year 2, year 3, year 4, year 5, year 6, year 7. Okay. So my savings for year 1 are going, this is like a cash inflow because I'm saving money. This is 390. This is 400,000. This is 411,000, 426,000, 434,000, 435,000, 436,000. These are savings. Okay. Same time over here as well, I'm going to have a maintenance cost in year 5 of 100,000. Okay, so that is going to be, and I can do this separately or I can combine them, but I'm going to go ahead and do it this way. So this is going to cost, although I'm getting the savings, it's going to cost me 100,000 at the end of the 5th year to go through and do this, right? So then my salvage value at the end of year 7, when I sell the equipment, is going to be 400,000. So my total future inflows basically from year 1 is going to be 390. And there you go. Now, these are all the future cash inflows that are going to be happening, right? However, these are occurring in future years, right? When I'm doing net present value, I have to bring these future amounts back to today's value. So how do I do it? I do it with present value. I have 2 tables to choose from: present value of $1 or the present value of an annuity of $1. I can only use this table if the amounts are the same. The amounts are all different every year. So what I'm going to do is I'm going to go to the present value of an annuity of $1. Okay, so for this first one right over here, this is going to be present value of $1, 1 period at 9%. So what I'm going to do over here is I'm going to go to the present value of $1, 1 period at 9% is 0.91743. So 1 period at 9% is 0.91743. Okay. And what I'm going to go ahead and just do is let's just go ahead and do our little table over here: 0.84168, 0.77218, 0.70843, 0.64993, 0.59627, and then 0.54703. So what I'm going through and doing is that each one of these dollar amounts, so in year 2 at 9%, it's 0.84168. Year 3 or period 3, 0.77218, 0.70843 for year 4, 0.64993 for year 5, 0.59627 for year 6, and 0.54703 for year 7. So let's go ahead and put those in over here. So this is going to be present value of $1. And this will be at 2 periods at 9%. This will be 3 periods at 9%. This will be 4 periods at 9%. This will be 5 periods at 9%. This will be at 6 periods at 9%. This will be at 7 periods at 9%. If you do not understand how present value works, go back and I'll put a link at the bottom of this video that goes over bonds, right? From financial accounting, that's one of the things we kind of assume going into managerial accounting, that you know how to deal with it. So right over here, what am I going to do at this point? Well, I'm now going to multiply my cash inflow year 1, multiply that by 1 period at 9%. So over here, I'm going to go ahead and basically multiply this through. This is going to be 400,000 times 0.84618. This is going to be 411,000 times 0.77218. This is going to be 426 times 0.70843. This is going to be 334 times 0.64993. This over here is going to be 435 times 0.59627. And then this is going to be 836 times 0.54703. So now what I've done is I've made these future dollars, I've made them comparable to today. So my total sum of all my cash inflows is going to be 2,247,398. So my total present value of net future cash inflows is going to be this right over here. Okay, less my outflows in year 0. And so over here, my net present value is going to be negative 37,702. So after going through and doing all of this, what I would go through and say, it does not meet the requirement. So at the cost of capital at 9%, it does not meet the investment criteria, as there is a negative net present value. The investment does not meet the criteria required for the company, or that cost of capital. So again, when you're doing these questions, and what can be really tricky is saying, well, like, what's actually a current cost? Like, what is actually going to be an outflow? Just remember, cost of the new machine, I sell the old machine, I got to pay for some training right over here. And if we look at this over here, that price that I paid for the old machine, that maintenance to keep it operational, don't care about that stuff. So that is exercise 25-3. I want to thank you for being here today with me. If you have any questions, feel free to ask, and don't forget to like and subscribe. I look forward to seeing you on the next video. Have a great rest of your day.